Hello and welcome to Dart Bank Insights. I'm your host, Brendan Andrews, and today we have on Bryan Clark, who's the Senior Vice President of Mortgage Banking at Dart Bank. Bryan, welcome.
Thank you. Thank you.
So tell us a little bit about your experience in the mortgage area.
Well, I've been in the mortgage business my whole career, actually. I graduated from Michigan State University and immediately became a mortgage banker, and that was back in 1994. So I've been in the mortgage business for 25 years. I was an actual loan officer, a mortgage banker for approximately 10 years up until 2004. And then in 2004, I eased into management at that point. Over the last 25 years, I've participated in probably tens of thousands of financing real estate transactions.
Why don't you tell us a little bit of trends you're seeing right now in the mortgage area?
Well, one of the major themes we've seen, especially for home buyers over the last few years, has been the lack of inventory. The demand for housing has far exceeded the supply that's been on the market, and that's had an adverse impact on our local housing market from the standpoint of it has driven up home prices a little bit higher, it's driven up home prices a little more than what it normally would increase. So that does erode a little bit at home buyers' affordability. And so we are starting to see an easing of that, where we are seeing more homes enter the market. We are seeing home builders start to be able to provide some more inventory as well, although their lack of skilled labor is causing some problems in getting some additional homes into the market like they would like to. We're seeing interest rates relatively flat. They do not anticipate that interest rates will increase any more than over 5% by the end of 2019, so that's good. 5% is historically a low rate, so that definitely helps with the home buyer affordability, keeping those rates low, as far as a historical measure goes. So that is helping as well.
Can you explain a little bit about the home buying process if someone is sort of trying to buy their first home and they have no idea of where to start?
Well, I think the first thing is you want to start with a local lender, first and foremost. Yeah, that's before you even really start to thinking about homes and what you'd like. It's wise to get with a local lender. And the reason for that is we can tell them, the home buyer, we can tell them how much they qualify for. So, what price range should they be looking in? And then secondly, we can talk to them about loan programs and the corresponding down payments that would be required, and do they have the available funds to be able to make that purchase. So that's really step one. We can evaluate the credit, we can evaluate income, we can evaluate some of the important items and get those out of the way prior to actually looking for a house and securing a home. So that would be step one. After we've secured that pre-approval or that pre-qualification, then it's time to reach out to a local realtor and have them start to show homes that are in the price range. Once the realtor's found a home, an offer is written and hopefully accepted. And then we really begin our loan process at that point, where the home is appraised, the loan is underwritten by one of our underwriters, and we move to closing typically within about 30 days from that happening.
Can you explain what a home equity line of credit is?
Oh, sure. A home equity line of credit allows a homeowner to tap into the available equity that they have. It's a revolving line of credit, and so you can use it somewhat similar to a credit card, where you might pay it down and then reuse it later on. So if you have equity in your home, you can tap into that for debt consolidation, home improvements, whatever needs you might have. A lot of people use it for paying for college education for a child or something like that. So there's big benefits in being able to use that home equity as a tool for one of those purposes.
Okay. Can you explain what an amortization is?
Amortization is basically the process of paying down a debt over time with regular payments. When a home buyer closes on a mortgage with us, we provide them what's called an amortization schedule. And the amortization schedule shows them with each and every payment they make, how much is going to go towards interest, how much is going to go towards principal, and then lastly, what the remaining balance will be after that payment. So that's what an amortization schedule does, is it shows that breakdown of that gradual paying down of the debt.
Explain what an APR is and why it's important.
Well, the annual percentage rate, it's commonly confused with what the interest rate is, and it's not exactly the same. They're two different things. When you take out a home loan, you have an interest rate that you secure with your loan, but the annual percentage rate also takes into consideration the costs that you paid to obtain the financing. So it's almost a calculation that takes into consideration the interest rate plus the upfront costs that you paid to obtain the financing. And the annual percentage rate then allows you a tool to compare from lender to lender what the best deal is by comparing the APR.
Can you explain what an escrow is?
Sure. An escrow account is an account that we set aside on the behalf of the borrower, that we pay the taxes and insurances out of. So the property taxes and the homeowner's insurance gets paid out of an escrow account. So each and every month that you make your monthly payment, part of your property taxes and part of your homeowner's insurance goes into the escrow account, in which when those come due, we pay those bills on the behalf of the home buyer to the municipality or the homeowner's insurance company.
And that makes it convenient for the customers.
So
they don't have to worry about it.
It does.
Can you explain what PMI is and why some people are required to have the PMI insurance?
Sure. PMI stands for private mortgage insurance, and this came out of back in the even prior to the 1950s, late 1950s. Mortgage lenders, banks, didn't like to make loans to home buyers with less than 20% down. And so private mortgage insurance kind of evolved from that, where it enticed banks to lend to home buyers with less than a 20% down payment, because what private mortgage insurance does is it's a premium that the home buyer pays that insures us as the lender in the event that they were to default on the mortgage. So it takes away a lender's risk of default, because we have that insurance policy that's behind there that insures our risk. And so now you can get mortgages with as little as 0% down. And we're willing to do that because we know we have that private mortgage insurance policy in effect.
Would you explain refinancing your mortgage?
Sure. Refinancing is essentially replacing the current debt that you have on your home. And similar to the home equity line of credit, it's typically done for a couple of reasons. It could be done that you want to take cash out for some reason, debt consolidation. It could be done for home improvements, but it also can be done if you just simply want to lower your interest rate or lessen your term, maybe move from a 30-year fixed rate to a 15-year fixed rate or something like that. So it really allows you to take your existing loan and replace that with a brand new loan for another purpose.
Can you explain a 15-year versus 30-year fixed loan?
Yeah.
And what are the advantages or disadvantages of going with one or the other?
Well, sure. A 30-year fixed rate is exactly what it sounds like. Your rate is fixed for 30 years. Rates tend to go up and rates tend to go down, and the beauty of a fixed rate is that it's never going to fluctuate, so you know the predictability of what your payments are going to be. A 30-year fixed rate in comparison with a 15-year fixed rate will offer a lower payment because you're stretching those payments out over a longer period of time. The benefits, though, of a 15-year fixed is that, one, it's a lower interest rate, and two, you're paying your home off sooner, obviously, in 15 years versus 30 years. So the major benefit that comes out of that is you're paying a lot less interest over the life of the loan. And so there are benefits of a 15-year fixed rate if you can afford it. Many borrowers opt for the 30-year because they like the option of the lower payments. But the 15-year can be a great option as well.
If you're a younger adult looking to buy a home right now, what are some tips or advice you have for them?
There are low down payment options available for any home buyer that might qualify. And I think one of the biggest things that young home buyers worry about is the lack of a down payment. And we have a plethora of loan programs that allow for, like I said earlier, as little as 0% down. Not everyone qualifies for that, but my advice would be seek out the advice of a professional, because we can certainly advise you on what's available. Many people are concerned about their student loan payments. Young home buyers are concerned about student loan payments. We have programs that we can work with student loan debt as well. So those would probably be the two pieces of advice I would have is, seek out a professional, because we can help you through that student loan issue as well as the down payment issue that many people are concerned about.
Excellent. Well, that wraps up today's Dart Bank Insights podcast. Thank you, Bryan, for being on the show. Look forward to having you back on.
Great. Thank you very much.